We are seeing a record plunge in shares of Shopify. The stock down 1 point, more than 21%. There you can see it down 19%, even as it grew sales more than 20%. The value of goods on its services more than 20%. But it was the forecast that suggested a bit of a deceleration in growth, but not by much. Bruce Croxon, co-founder of Round 13 Capital, joins us now. And I just love to get your perspective as the VC that traffics in private markets when you see this kind of public market reaction to a company you knew very well when it was starting out.
I mean, I think that's the good and the bad of the public markets, right? I mean, and by the way, like I heard this on the way over to the studio, so I have no idea why or what, this or that. So, but at 10,000 feet, I've known these guys since they started the company. They've made relatively few missteps. In other words, I think it's a very, very well-run company. Are they getting some headwinds like every other retailer, e-commerce or other, because interest rates are too high and consumer demand is off? Maybe. Does that put pressure on revenue and margin? Of course it does. Have they gotten out of things that have proven to be unprofitable? Yes. I think they have an incredible moat when they set out to democratize buying and selling on the internet. And I think they've done an exceptional job. And long term, I don't see it going anywhere.
Well, I feel like this is a really VC way to think, right? You think about the financials, the margins, like that does come eventually, but you're thinking about a company that can do what Amazon does, but on a white label basis. So almost anybody can have their own online presence.
Well, and I remember so many times we talked about Amazon and, you know, when they were losing money all those years but basically on their way to owning a market. And anytime they wanted to drive more margin or profit, they could have by shutting down their growth plans. And that's the last thing you want to do in a market where there's still a lot of people moving online and need their things executed. So, you know, I'm not as you know, I'm not a public market trader, but I was so excited at the 20% drop. I bought shares in the waiting room.
Look at that.
I'm just waiting. Like, I mean, these guys know they're an exceptionally run company.
It's interesting you talk about, you know, the strategy and now that they're a public company. So they were going to build this logistics business that would give not just the Amazon storefront capability, but then the Amazon logistics part. But you'd have to lose a lot of money to do that. It's going to weigh on margins. And so they pivoted.
Gave it a shot, learned some things, pulled back, right?
Well, I wonder if in the long term, is that a mistake to abandon? Just because the public markets wouldn't like it. I mean, they really wouldn't like it. Who knows what that would have meant for the company.
You know what? I've never got the impression that these guys run their company based on what they perceive the public market will like or not like. I think they've been pretty clear on that. And I don't know the details, so I'm just based on what this two people talking, you know, you take on Amazon in anything. Amazon's willing, as they've proven over and over, they're willing to lose a lot of money in order to secure what they think is their business. So it may very well be no more complicated than that.
It makes me think of another sector where it's a lot of promise and like we're pretty sure it's the future, electric vehicles.
Pretty sure,
Pretty sure. But are we? You know, sales are slumping maybe for Tesla. For Rivian, which recently reported. Still losing a lot of money. Production is hit and miss.
But Tesla's making money. I don't know about the last report, but they had been up until then. They're EVs are like 6.5% of the total market now. Tesla owns 60% of it, right? So that's a big market. I think as it pertains to the latest hiccup, I'm going to call it a hiccup. I think a lot of early E enthusiasts bought their product. I don't think they're immune to what's going on in the market like anybody else. High interest rates tends to depress demand for, as we know, is a higher than average cost material, which is an electric car. So I think they're taking a pause on that. They've got competition. We always talked that it was only a matter of time before the big automakers sort of said, okay, we got to get going. And I think that's siphoned off a lot of the demand. So big picture, I don't think the market's going anywhere, Amber. How Tesla does, relatively speaking, as the Chinese come in and the automakers get their act together, no comment. But I think EVs are here to stay. So that puts you on to a little player like Rivian, you know, and I'm not a stock owner, but I'm biased because I like the looks of the thing. I mean,
I've started to see some on the road now.
Pretty funky looking vehicle, right?
Definitely so better looking than the Cybertruck.
Us pickup enthusiasts, you know, like I might trade my Tacoma in for one of these. But the pickup trucks are at 17% of the market. Rivian has 0.4% of that. So it's a smaller market. They're off to a much quicker start than Tesla was in terms of getting their machines out the door and production scaled up, believe it or not. And then it's just a question as an investor, which is what your viewers, I think, are most interested in, are the billions that they're going to burn. I think they burned 4.6 billion last year. They've got 10 and change left. Is the investment going to be worth it at the margin for the size of the market that they're going to be able to capture? And don't forget, all the things we talked about with the other car makers coming in to take a bite out of Tesla, you better know that they're doing it on the pickup side too. So they've got those things to contend with as well.
All right, fascinating. We'll see you in a Rivian maybe one day.
I hope so.